Hey everyone, thanks for joining us today. My name's Hayden Hulsey, one of the brokers here at Results Commercial. So today we're going to talk about partnerships. We get this question a lot. Is it good to have partners? Is it not? Should you go solo? 2, 3, 4, 5 people, syndication, all of that. So we'll touch on it. So let's start with the positives of a partnership. One of the most obvious ones is money. Of course, if you're buying a property, you got to have that down payment. If you're buying something that's say, $1 million and you're looking at 25% down, you're talking $250,000. If you go in with a couple buddies, you can get there a heck of a lot faster than individually. The second is going to be financing ability. So if you are getting, putting debt in place versus cash, if you've got 2, 3, 4 people on that underwriting, it's going to be a lot easier to qualify than a single individual. Then if you do purchase that deal and you move forward, and let's say it needs a new parking lot, roof, HVAC unit, whatever it might be, you need to have that money to go put into the property to keep it going and running right. One of the other pieces here is splitting responsibilities. So you want to be able to have partners that work well together and complement one another. So you want somebody who's maybe good at the number side, who can handle the books, the logistics, rent collection, all the rest of it, while somebody who might be better on the logistics and property management side. Therefore, those two will work together well. Now, another positive here is sharing in the losses. So Mark has done videos on, worst case scenario and how is, running those different, scenarios. With that, let's say, especially in a pandemic, your retail strip center is 75% vacant. You're sharing in those losses with somebody. It's not just you as an individual having to carry that load. Now, another piece here that's a positive with a partnership are the resources and knowledge. You're working with another person, therefore everyone is usually bringing different pieces to the table. So if you can hit on something with a buddy of yours that has, let's say, more of a tech side experience of, marketing, advertising, trying to find different, tenants, that can be a good complement versus somebody who might be more on the CPA side. You guys are working together on that deal. Now, leverage, of course, this allows you to get into more deals easier. So if you have partners, you might be able to get to, say, 4, 5, 10 deals a lot faster than, of course, by yourself. If you're an individual with those down payment monies, you're restricted. Now, I'm not saying one's better than another because there's certain people, let's say Dave Ramsey, for example, that'll argue, don't put debt in place, pay off your properties, everything changes, your risk tolerance is a lot different. In that case, that can make sense. Now, other people say you want to lever up because if you look at IRRs and ROIs, you're going to get a lot better meaning, higher net worth faster. There's two sides of that fence. So let's touch on some of the cons of a partnership. So we sell a lot of properties of partnerships gone bad. This is one of the most obvious ones, whether it's divorce, two partners that, are going their separate ways. They simply don't get along. Lifestyles have changed and therefore one partner isn't in a position to go throw capital in that deal. That's where we come in as brokers and we specialize in representing sellers, so we'll take those products to market. For us, we're not complaining, of course, but we see the bad side of partnerships all the time. Now, another con here would be splitting profits and appreciation. So when times are good, you're making a lot of money, you want to keep that money. If you got a partner, 50-50, you're splitting it with somebody else. And of course, appreciation. If that property's going up, let's say 3-4% each year, you're holding it for 10 years, that's some good appreciation, but you're sharing that with a partner, which isn't a bad thing, but just not as much for yourself. You're also not getting as many tax advantages, meaning depreciation write-offs, you're sharing in those as well with somebody else. Now, a big one here, this kind of touches on the same thing with us selling partnerships that have gone bad, are disagreements on buying, selling, and operations. So you might find a really great deal that you love and you want to go jump on it right away before somebody else does. Your partner might not be on board. It might not be a good time. Same thing with selling. Let's say your lifestyle has changed. You want to get away, you want to move to Colorado, go ski in the mountains. Your partner's not ready to hang it up. He doesn't want to sell. You're stuck. You got to sit there. You could get into buyouts and some of that, but it makes it a heck of a lot more difficult. And then operations. This is a big one. Can you agree on who is doing what with the property? Can you agree on when's a good time to replace the parking lot? Do you want to put money in? Do you not want to put money in? Another piece here, another con to a partnership would be capital calls. Capital calls are when you need capital for the deal. Let's say your vacancy is high, the property needs some work, you need some money. So, you might reach out to a partner and say, hey, we need to put $20,000 into the partnership. Are they in a spot to do that? It's tough to say. Now another one here with the partnerships are, you see a lot of friendships that have gone bad. Now that's, outside of the real estate piece, but you get a good buddy from college, you say, and it sounds like a good idea. You guys are making some money, you want to go buy something. It's pretty easy for that partnership to go bad. Same with that friendship. So you want to be careful there. In the partnership discussion too, just kind of one piece I want to add is, Mark and I discuss partnerships quite a bit. And the conversation is around the pros and the cons that we talked about. But me personally, whether right or wrong, I'm usually the kind of type that says, can I do this solo? Not that I don't want to work with somebody, but in real estate, I'm kind of a risk taker, and I would like to, take advantage of rolling the dice a bit. I'm young, I have some time on my side. I want to see if I can really get that upside by going into that deal myself. Now, I want all the resources and you want a great team around you and all of that. So that's not to say you don't want those pieces, but I don't want to dilute too much, because I would like to really, and I'm pretty careful in what I do buy though, but I want to really see that appreciation. I want to get my depreciation. I want to have those write-offs. I want to get those different pieces. And through this, I've learned about it through, of course, going through education and, CCIM and those kind of pieces. You learn about the different structures and what works. One of the most important, of course, is, when you're growing up around it, you see what works and what doesn't work. And Mark, who, he's owned a lot of properties, a lot of real estate, I've seen him and, his wife, my mom, Nancy, they've bought a lot of real estate. They didn't do it with partners. Now they've had great resources around them, but you see what can work and what doesn't work. And then of course brokerage, it's the best way to learn, I think, hands-on, is you see every single day what is working, what isn't working. So the positives with the big firms though, those are partnerships that do work, in my opinion, because it's a business. They have it structured very well. They have it clearly defined. Here's what each person does. Here's the role. And usually you have the money folks and then the operation and the business. So I think in those cases, that is what interests me, because that's very clearly defined and that's more of a larger commercial real estate structure. For more of that smaller multifamily, some of those pieces, that's where I prefer on my own to just buy the deal myself. So on this piece here, we'll talk a little bit about how to create a healthy partnership. Not that we're getting into psychology here in that whole field, but with real estate partnerships, I think strongly that there's a right way to do it and a wrong way to do it. So number one is you want a clear partnership agreement. So you want to know who is going to do what. So if you set those expectations right up front, everyone should and hopefully be on the right page. If you don't, it's ambiguous, you don't know who should be doing what, and then that's where those disputes can start. You want to find a partner that complements you. I talked about this a little bit earlier, but you want to find somebody who isn't just good at all the same things as you. You want somebody that's good at the things that you aren't good at. Therefore, you guys feed off of one another. This is a really obvious one, but it's important. You want to have money. You don't want to go into bed with a partner that doesn't have the cash. Now, maybe if they have, incredible knowledge and you can offset that, that could make some sense. You see that a lot with, say, a real estate broker might source the deal and they aren't actually putting equity in. But you want to make sure in general that both partners are well capitalized. And of course, one of the last ones is know your partner. In a typical partnership, that's not speaking to a syndication necessarily, which it still is valid, but this is more if we're talking a typical 50-50 or three partners to where it's a third. You want to know who you're working with. So let's touch on types of partnerships here. So there's many different structures. Of course, you have the traditional 50-50 structure. You then can get into different partnership arrangements where there's limited partners and there's a sole member who's actually running the deal. That's where that partnership agreement comes into place, because if you are, sourcing money, equity, debt for a deal, and you are a sole member decision maker, that can be a good way to do it if you don't want your partners slowing you down. So you might know everything about real estate, you might know what needs to be done. You can arrange that partnership, assuming everyone's on the same page, that you are the decision maker, you're running that deal, so that a partner who doesn't have that real estate knowledge isn't slowing somebody down, for example. Now, some of you might have heard of, the IRR waterfall. That's a pretty common one. We're not going to go into that, but that talks about different repayments, preferred returns. That's a good example of one of the most common payout structures for a partnership. So one of the issues that you can run into here with partnerships is you'll get a broker that might just throw in their commission. That's their equity for the deal. versus other partners that are coming in with actual cash. We see a lot of disagreements here, and we've seen it at closing tables even, where that broker, who might be a majority partner in the deal, isn't actually coming with any cash, is just coming with the knowledge and the commission. I'm not saying that's bad, but it can lead to disagreements. You just need to be careful there. Now, another bigger, larger partnership that you've probably heard a lot about are syndications. That's crowdfunding, that's raising money. Those are usually larger deals. And then, of course, you can get into different, capital, meaning debt, equity, who's coming with each of those, which we won't get into that today. One more piece to bring up is, do you really need a partner or just a third-party resource? So there's cases where it might make sense to say, can we just pay hourly for that attorney, for that contractor, for whatever that different service or field might be, versus bringing that person into the deal. So a contractor, for example, if you can get a contractor on board and they're getting, let's say 30% of the deal and they're doing the work, of course, pro bono, that can work out well. However, the flip side could be, are you giving away too much? Giving away too much of the farm? Can you just pay that person separately? You run the deal with maybe a partner or two versus splitting it up too much. Thanks for joining us today, guys. That was a quick overview on should you have partners and some of the pros and cons. So don't forget to check us out on YouTube, subscribe, got a lot of good content and even more coming. Thank you.